Have you ever wondered what exactly happens when you buy a stock? Let's take a moment to unravel this mystery, shall we? The stock market, in its simplest form, is a marketplace where buyers and sellers trade shares of publicly listed companies. Each share, or stock, represents a piece of ownership in a company. This concept might be a bit tricky to fully grasp, so let's break it down. Imagine you've baked a giant pie. It's too big for you to consume alone, so you decide to share it with others. You slice the pie into pieces, and offer each piece for a price. Each slice represents a portion of the whole pie, much like a stock represents a portion of a company. Now, why would a company want to slice up its pie and sell it? Well, companies issue stocks primarily to raise money. This could be for a variety of reasons like expanding their business, paying off debt, or funding research and development. In return for this capital, they offer a piece of their company's future profits. The stock market operates on the basic economic principles of supply and demand. If a company is performing well and is expected to continue doing so, more people will want a slice of that pie. This increased demand can drive up the price of the stock. On the other hand, if a company is performing poorly, demand for its stock might decrease, causing its price to drop. In the words of the renowned investor Warren Buffett, "Price is what you pay, value is what you get." So when you buy a stock, you're not just buying a piece of paper or a digital number on a screen. You're buying a piece of a company's future and betting on its potential to grow and succeed. So a stock represents a claim on part of a company's assets and earnings. Interesting, isn't it? Stick around as we delve deeper into the world of stocks and stock exchanges in the upcoming scenes. You have heard of the New York Stock Exchange or the Nasdaq, but do you know their role? Well, let's unravel this mystery. A stock exchange is like a grand bazaar for securities, particularly stocks. It's an organized marketplace where shares of publicly traded companies are bought and sold, essentially serving as the backbone of modern capitalism. At its core, the function of a stock exchange is quite simple. It provides a regulated and centralized platform where buyers and sellers can come together to trade stocks. Think of it as a farmer's market, but instead of selling fruits and vegetables, traders are dealing in shares of companies. Now you might ask, how does a stock exchange set prices for these stocks? It's not like there's a big price tag hanging off each share. Well, the answer lies in the fundamental principles of supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. This constant tug of war between buyers and sellers determines the price of stocks at any given moment. Stock exchanges also ensure that this trading process is transparent, fair, and efficient. They impose rules and regulations to protect investors and maintain the integrity of the market. For instance, companies listed on these exchanges are required to publish their financial information regularly. This transparency allows investors to make informed decisions. Moreover, stock exchanges play a crucial role in helping businesses raise capital. When a company decides to go public, it sells a part of its ownership in the form of shares on a stock exchange. This process, known as an initial public offering or IPO, helps companies raise funds for expansion or debt repayment. In a nutshell, a stock exchange is not just a marketplace for stocks, but a catalyst for economic growth. It serves as a barometer of a country's economic health and a gateway for companies to access capital. So, stock exchanges essentially act as marketplaces where buyers and sellers come together to trade stocks. Ever wondered what the Dow Jones or the S&P 500 actually measure? Well, let's dive into the world of stock market indices to figure that out. A stock market index, in its simplest form, is a measure or a calculation that represents the performance of a group of stocks. Think of it as a thermometer, but for the stock market. It's a tool that investors and financial managers use to describe the market and to compare the return on specific investments. Now, every index is different, and they each represent a different part of the market. The Dow Jones Industrial Average, for instance, consists of 30 large, publicly owned companies based in the United States. It's often used as a proxy for the overall health of the US economy. The S&P 500, on the other hand, is a broader index covering a vast cross-section of the US equity market. But how are these indices calculated? Well, each index has its own unique method, but in general, an index is calculated using a weighted average. This means that companies with a higher market value have a larger impact on the index's value. So, why are these indices so important? The answer lies in their role as representatives. Just as a member of parliament represents a group of people, A stock market index represents the performance of a group of stocks. It allows us to look at the performance of an entire sector or market at a glance, rather than having to sift through the performance of each individual stock. Moreover, these indices serve as benchmarks against which financial or investment performance is measured. This means that when you hear that the market is up or down for the day, it's usually in reference to a stock market index. But perhaps the most important role of stock market indices is their ability to reflect investor sentiment and expectations about the health of the economy. When indices are moving upward, investor confidence tends to be high. When they're moving downward, it could signal that investors are becoming more cautious. In other words, indices give us a quick glimpse into the health of the stock market and the economy. They're like the pulse check on the world of investing. So the next time you hear about the Dow Jones or the S&P 500, you'll know exactly what they're talking about. Why would anyone risk investing in stocks given their unpredictable nature? This question is often at the forefront of the minds of individuals contemplating a leap into the world of stock market investments. It's a valid concern, and the answer lies in the delicate balance between risk and reward. Investing in stocks can be likened to a thrilling roller coaster ride. The ups and downs, the twists and turns, can be nerve-wracking. But just like a roller coaster, the exhilaration of the ride, the potential rewards, can make it all worthwhile. Imagine buying shares in a small startup company that explodes into a global phenomenon. Suddenly, your initial investment has multiplied several-fold. This potential for significant financial gain is the allure of investing in stocks. However, it's crucial to remember that this isn't a guaranteed outcome. The startup could just as easily falter, leading to a loss on your investment. This is the risk we talk about. So how do we manage this risk? Enter the concept of diversification. Picture your investment as a pie. Instead of putting all your eggs, or in this case your money, in one basket, you divide the pie into several slices, each slice representing a different investment. These could be in different companies, different industries, or even different types of assets altogether. This way, even if one slice doesn't do well, the others might still hold up, buffering your overall portfolio from significant losses. Renowned investor Warren Buffett once said, "Do not put all your eggs in one basket." This is the essence of diversification. It doesn't eliminate risk completely, no strategy can do that, but it does help to spread it out, making the investment journey a bit less tumultuous. In conclusion, investing in stocks is a game of risk and reward. The possibility of high returns can be enticing, but it's important to be aware of the inherent risks. And when it comes to managing these risks, diversification is key. Remember, high risk could mean high reward, but diversification is your safety net. So, let's quickly recap what we've learned about the stock market. At its core, the stock market is not as enigmatic as it may initially seem. It's a marketplace, much like any other, where buying and selling takes place. The commodities in this case, however, are shares of publicly traded companies. We delved into the role of stock exchanges, the hubs of this financial activity. These are organized markets where securities such as stocks are bought and sold. Some of the most notable ones include the New York Stock Exchange and the NASDAQ. Stock exchanges provide a transparent, regulated, and convenient venue for companies to raise capital and for investors to trade shares. Next, we touched on the significance of stock market indices. These are essentially scorecards of the stock market's performance. Indices like the Dow Jones, S&P 500, or the NASDAQ Composite give us a snapshot of how a segment of the market is doing. They're valuable tools for investors to gauge market trends and compare the performance of their own portfolios. But of course, the stock market isn't all about making quick money. It's a game of risk and reward. Investing in stocks can be lucrative, but it also comes with its fair share of risks. Market volatility, economic changes, and company-specific risks are just a few of the factors that can impact the value of your investment. That's why due diligence, patience, and a well-diversified portfolio are crucial for anyone looking to dip their toes into stock market investing. Remember the words of renowned investor Warren Buffett, "Risk comes from not knowing what you're doing." So continue to learn, continue to grow, and keep a keen eye on market trends and company performances. Understanding these basics is your first step into the fascinating world of stock market investing.